So based on the name itself, you can tell something about the standard. So IS 20, accounting for government grants and disclosure of what? Government assistance. Now look at this. You are saying what? Accounting for government grants and just disclosure of what? Government assistance. So all what you need to know is that when it comes to government grants, that one we are going to recognize it. But for government assistance, that one just needs some disclosure. Okay, you just have to disclose it in the financial statement, the disclosure. Okay, so if I talk about recognize, I'm just trying to say that this one will be shown on the face of what? The financial statement. Okay, so it can be the P&L and also the statement of financial position. So all what you need to know is what to get the difference between government assistance and what government grants. So we have some definitions here. We are saying government, can talk about the central government, government agencies, the local ones, the local government and all that, NGOs and all that. And also government assistance. Government assistance. So we are saying that this one is an action by government designed to provide an economic benefit specific to an entity or range of entities qualifying under certain criteria. And this one is saying that a common form of government assistance is what? Government grants. So this is to tell you that government grant is a subset of what? Government assistance. Hello. So government grant is a subset of government assistance. Okay. So government grants will be recognized on in the financial statement. So let me just use some diagram to explain it here. Right. So okay, so first one we have the government grant. So this one will be the assistance, and this one will be the government grant. Okay. So with the government grant and the government assistance, you are saying that this one includes all form of support, whether in kind or in form of transfer of economic resources. Okay. All right. Let's talk about the government grants. Okay. Let's talk about the government grants. The government grant is a form, first of all, it's a form of government assistance. So as I said, this one is a subset of government assistance. All right. This one involves transfer of economic resources. Now, please, in accounting, if you talk about economic resources, what does that mean? Hello.
Yeah, hello.
I'm asking a question. Economic resources is a simple term, and it's one of the the most common terms in what? Accounting. So how do you understand it?
It will be cash or assets.
And so please, that's the opinion. Please, who again?
Um,
Economic resource.
I was thinking cash, personnels, and like labor. Yeah.
So please, what's the definition of assets? The modified one, no, not the old one we used to.
You don't want the wear and tear one.
No, 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 that one is the old one.
It is something something that is useful economic life, something something something. It has
That the future economic benefits will flow to the
yeah,
entity, right? Uh-huh.
yeah.
So if you hear of economic resources, that one is just assets. Okay. Then obligation to is what? Liability. So please. Oh, I knew we were okay with this term, so that's why we didn't even start with the conceptual framework. But initially, it was part of the topic, but I think the syllabus, the new syllabus is not part. So please, I'll send you a document for you to read. It contains all these terminologies, okay? The recognition, measurement, disclosure, and all that. Okay. So let's continue. Let's continue with the government assistance. So the government assistance, okay, can be either the government grants or any other assistance does not include transfer of assets. Okay. So we have other assistance that does not include transfer of or economic resources. Okay. And you know that for economic resources, we can place value on them. Okay. We can place values on them. But with the other forms of assistance, some of them you cannot place value on them. And that is what you are going to disclose. But the ones that you can place value on them, that's the transfer of economic resources. That is when you will be recognizing it in what your financial statements. Okay. So I think this diagram that I'm doing should help you do everything. So with the government assistance, as I said, please a minute and let me do some settings. Okay, so we have the transfer of economic resources. I also have the assistance that does not include what transfer of economic resources. What's happening? Okay, so as we all know, the one that involves the transfer of economic resources, what government grants. I'm sorry, okay. I don't know what's happening. Okay. And the one that does not include a transfer of economic resources is known as what? Government assistance. Just want to summarize the whole thing. And we are saying that this government assistance should only be what? Disclosed, because disclosure of what? Government assistance. The one that we cannot place values on them. That one should be what? Disclosed. Okay. So the government assistance we have, this one should be disclosed. Okay. Please pause the video for me. I'm coming. Let me do something. Okay. This one is notes. So the government assistance should only be disclosed in the notes. We are saying that the disclosure, you should disclose the nature of assistance. Okay. The nature of assistance. And also, should disclose what? The conditions, okay, attached to that particular assistance and all that. And also the effect of that particular assistance. Okay. So that's all. So we can talk of some examples. Example, we have the local operating license. We can also talk about all the tax incentives. They are all assistance. Okay, they are all assistance. For instance, local operating license, you cannot place value on them and all that. So let's look at those that we can place values on them. And this one, that's the main deal. Okay, so that's the main deal. Okay, so these ones are recognized. These ones are recognized. Okay, in the financial statement. Okay. So please, we move on to talk about the types of the government grants. So let's read from the notes. I think the whiteboard is not allowing me today. I don't know. So the assistance by government in the form of transfers of resources to an entity in return for past or future compliance with certain conditions relating to the operating activities of the entity. They exclude those forms of government assistance which cannot, okay, reasonably have a value placed on them. Okay, so let's see. So it does not include the government assistance, because the one that cannot reasonably have a value placed on them should just be disclosed. Okay, now let's talk about the types of government grants. Okay, the types of government grants. We have grants related to assets and grants related to what? Income. The one related to assets is also known as capital grants, and the one related to income is also known as what? Revenue grants. Revenue grants. All right. So We are saying that whenever whenever the grants given by the government, okay, does not have any related expenditure, or a grant is given without any condition attached, it must be credited to the profit or loss immediately. So mostly the grant that will be given, the government grant, the one that have values on them, we have conditions attached. Mostly we are saying that you should not make redundancies. If it's an asset, you should not dispose of the assets. Okay. Sometimes if it is a revenue expenditure, what are you going to use it for? Maybe to plant trees, to subsidize the salary of staffs and all that. So these are the conditions attached, okay, or the related expenditure. Now, if you are giving grants without any condition, okay, you don't have any condition attached to the grant given, or there is no related expenditure that you are going to use the grant to defray that particular expenditure, we are saying that you should credit it to P&L immediately. Now, I said it the other time, if you hear or see credit to P&L, it means you are adding to your other income, okay? And if you say that you are debiting it towards P&L, or debited to, it means you are deducting from your P&L account. So that one will be seen as an expense or a negative figure. But if you see credit to P&L, that one is a positive figure. Okay, so that's just by the way. So please, if you have a grant and there is no condition attached, just credit it to the P&L immediately. All right, so this is the scope. So in the revenue grant or capital grant, we have two ways of presenting that particular grant, okay, on the face of the financial statement. So one is what? The deduction approach, and the other one is what? The deferred credit, okay, the deferred credit. Now let's talk about the first one, the credit. Presentation as credit in the statement of profit or loss. So this one, I think that the supporters of this method claim that it is inappropriate to net income and expenses items, and that separation of the grant from the expense facilities, comparison with other expenses not affected by the grant. So this one is from their paragraph, the main document, the IS-20, the paragraph 30. So this one, I'll bring it down, I will explain for you, so don't worry about the writings. So the deduction approach is saying that this one is argued that the expenses might well not have been incurred, okay, by the entity if the grant had not been available, and presentation of the expense without offsetting the grant may therefore be misleading. In other words, presenting it separately might be what? Misleading. This is also their argument, okay? So we have the deferred credit method, and also the deduction approach, okay? So whether revenue or capital grant, we are going to use these two methods, and we are going to solve some examples, and I mean, you appreciate the concept very well. All right, so let's talk about the revenue grant, okay? The one which is related to income, this one, okay? Um, so revenue grant. Okay, so we are saying that the revenue grants, the standard allows revenue grants to be presented either as a credit in the income statement or deduction from the related expenditure. As I said, we are going to solve example. We are going to know how this deduction or reduction approach works, and also the credit approach works. So the examples of this revenue grant is what? They are received to: one, plant trees at the roadside; two, train students on ICT; subsidize the salary of staff; subsidize the cost of what? Maintenance. So these are all examples of the revenue grant. Now the capital grant also permits two treatments the same way: reduction approach and also the deferred credit. Okay, deferred credit. Now I want to, you see we have illustration here, but first of all I wanted to do this diagram approach so that I think it will help us. Let me use different. Come on. All right. So revenue grants, we have the this one is just given to defray what? A revenue expenditure incurred. Okay. So let's look at the methods. Let's look at the methods. So first of all, we have the deduction approach. So this one is deduction from related expenditure. And the other one, separate item of income. Let's look at the other one, the credit in the income statement. Okay. So with the deduction from related expenditure, let's say that the expenditure that you are incurring, okay, let's say if you are using, you are incurring costs on planting trees at the roadside, okay, let's say the whole amount involved is 5,000 Ghana cedis, okay. So if the government maybe give you this kind of grant, say 2,000 Ghana cedis, the project that you are embarking on, let's say 5,000, planting trees on the roadside, and also the grant that will be given is what? 2,000. You just offset it with the cost of your project. So the cost will now become 3,000. So in simple terms, this one is what? The deduction approach. So deduction is the simplest one, and at corporate reporting level, you not get that type of question. Okay. Now let's talk about the separate item of income, or the one we call the deferred credit method. The deferred credit method. Now that one, we are saying that the grant is treated as what? A deferred income. Now we all know that deferred income is also treated as what? A liability. But we know this accrual concept. Okay, accrual. So please, when do we recognize revenue and expenditure? We have this accrual and cash basis. So when you are using the accrual concept, what does it say? When do you recognize expenditure, or maybe expenditure and also income? Please, I'm listening. PSA. Hello. This one guys just basics in accounting. Please, when do you recognize revenue and expenditure?
Under the accrual,
Mm.
you recognize it as and when you earn or the expenses is made.
Thank you. So when you incur that particular expense or you earn the income, okay. So with this deferred credit method, let's say you have 5 years, okay. You have 5 years. We solve example and you appreciate the concept very well. So in year one, you only recognize that grant related to year 1 only. What about the 4 years left? Because the thing is 5 years. Okay, and we are saying that this type of the type, okay, the one here, deducted from related expenditure and also presented as a credit in a statement of P&L, right? Every year you transfer that particular grant from the deferred liability or the deferred income to your P&L. Okay, so let's say year 1, you transfer that of year 1 from the deferred income in under the liability to the P&L to what? Other income column. You recognize that what? Grants. Year 2, you transfer it. So you do that till the year ends. That's the 5 years. So that's what you are talking about, what? The deferred credit method. All right. So let me just do it here. So as I said, the first one, you just have to deduct the grant from the related expenditure. That's all. So with this one, first of all, you treat the grant as what? A deferred income. And this one is liability. And the statement of what? Financial position. Okay, so we are saying that the grant under the deferred credit method is transferred to the income statement annually. So every year you transfer that grant to us, I was saying. Okay. In the same way and manner. The expenditure is incurred. Okay, so this one is for the revenue grants. Okay. You move on to the capital grants too. That is the grants related to what? Assets. Okay. So the deferred income left, right, will be treated as a liability. And that liability, you are going to split between what? Non-current and current liability. Okay, so that's where the challenge is, because that's where people find it difficult. And today we are going to make it simple, right? I'm just trying to summarize the standards for you.
Okay, take care.
Okay, so as I said, you split it between what? The current and non-current. Now let's look at how this separation is done. Okay, if you have total deferred income as a liability, say 15,000, and you have to separate it. Okay, you have to split it non-current and what? Current. So let's look at the current portion or the current liability. How do we determine that particular amount? We are saying this is the amount that will be transferred to the P&L in the next year. So if you are in 2015, okay, the grant that will be transferred in 2016 will be the current liability here. So you solve a question and you understand what I'm trying to say. So the current portion is the grant or the amount, okay, that will be transferred. I know that place will pose some challenge, but you understand it. Then let's look at the non-current liability. Okay. So we are saying that this is the amount that will be transferred beyond 1 year. So this one is more than 1 year. So in this case, the next 2 years going. So the deferred amount or the deferred income left. Okay, so if you are in 2015, so the 2015 is what? The year in question. So the deferred income in 2016 will be the current liability, and the deferred income in 2017 going will be the non-current liability. So that's how we split it. So we will take a question and you understand. Okay, so you are saying this is the amount. So this one is beyond 1 year. Okay, beyond 1 year. All right. So let's talk about the capital grants. Okay, capital grants. The grants related to assets. The reason why I'm moving at a slow pace is this particular standards. It's is sometimes difficult. Okay, especially when you are come to split it. So I have to take my time and explain it for you to understand it once and for all. So this one too, we talk about the deduction approach. Okay. So deduction approach. So this one I just deduct it from the related expenditure. All right. So ascertain the reduced cost, and that's what you are going to use as your depreciable amount. In other words, you are going to calculate depreciation based on this reduced cost. Okay, so depreciation is calculated on that revised or reduced cost. Okay, so what happens in what? The statement of financial position. The PPE or that particular asset is carried at this reduced cost as the reduced cost less any accumulated depreciation. So we've done PPE, so you shouldn't get problem with the accumulated depreciation. So the deduction approach, first of all, you get a question. Okay, maybe the assets, the cost of the asset is say 10,000, and government will give you the grant, say 40% or maybe any amount, say 30,000. You subtract the grant from the cost of the asset to get the reduced cost of what? 70,000. So this 70,000 is what we term as what? Reduced cost. And this 70,000 is what you are going to use as your depreciable amount. In other words, you are going to charge your depreciation not on the original cost, but rather the reduced cost 70,000. And also, when you go to the statement of financial position, the PPE, you carry it at what? Or you recognize it as 70,000 less any accumulated depreciation. If there's one depreciation, just deduct your depreciation to get your what? Net book value or the carrying amount. Please, is the first approach under capital grant okay? Hello.
Please, can you take it again?
So the deduction approach, I'm saying first of all, the grant that will be given by the government will be deducted from the cost of the asset. So here you are going to purchase an asset, you are going to acquire an asset, and you apply for a grant, okay, for the government to help you. With this deduction approach, we are saying that you are not going to recognize the assets at what? The original cost or at the acquisition cost. Here, for this case, the acquisition cost is what? The 100,000. That's the price of the asset. Okay. Now the grant that was given is 30,000. You just subtract the 30,000 from the cost of the asset. Then you will get your reduced cost. And this reduced cost will be used as a depreciable amount. In other words, this 70,000 will be used as a basis when you are calculating your depreciation. And also, when you get a statement of financial position, you recognize it at the 70,000 less any depreciation. If it is more than 1 year, less any accumulated depreciation. You are not going to recognize it at the 100,000 here because it's the original cost. No, you've been given a grant of 30,000. So this approach is saying that we should deduct the grant from the cost of the asset. Then the reduced cost is recognized in the statement of financial position. Please, are you okay with that one?
Yes, please. Thank you.
Okay, welcome. So I think it will be quite okay when we are treating we are solving the questions. Okay. Okay, so we have the deferred credit method. So with this approach, we are saying that the assets is initially recognized at the gross amount. So first of all, you recognize the assets at the gross amount here, 100,000. You charge your depreciation on the 100,000. You recognize the asset in the statement of financial position with the 100,000 less any depreciations. Now let's look at how we treat the grant. So first of all, the depreciation is calculated on the gross. By the reduction approach, it was calculated on the reduced cost, but this one is a deferred credit. Let's look at the statement of financial position. So here the PP is carried at its gross amounts, okay, less any accumulated depreciation, okay, less any accumulated depreciation. In the statement of financial position. So that one there you know. Okay. Now let's look at the treatment of the grants. Okay. So here to the grant is set as a deferred liability. And we are saying that the transfer of the grant is made to the P&L or the income statement in the same way and manner depreciation is charged Okay. So you see, the revenue grant, you transfer the grant to the P&L in the same way and manner expenditure is incurred, because that one is the revenue grant. This one, okay, in the same way and manner the expenditure is incurred. But this one is capital, okay, capital grant. So this one will be transferred to the P&L in the same way and manner depreciation is charged. Okay, so please, let's start with the illustration here. So please read the first one for me. I think that one has the answer, but so let's discuss it. So please read the illustration one.
Illustration 1. A company is giving 300,000 Ghana cedis on 1st January 2021 to keep staff employed within a deprived area. The company must not make re the company must not make redundancies for the next 3 years, or the grants will need to be repaid. By 31st December 2021, no redundancy had taken place and none were planned.
Okay. So we have this grants amounting to 300,000. Okay. Now let's look at the answer here. We are saying that the grant should be released. The grant should be released over 3 years. Okay, over 3 years, because we are saying for the next 3 years. So the grant should be released over 3 years, meaning that 100,000 is taken to P&L each year. So it will be 300,000 divided by our 3 years. So it will be 100,000 per annum. Okay, 100,000 per annum. So every year you transfer 100,000 towards the statement of profit or loss. So in this case, by the year end, the 31st December 2021, the thing is 300,000. Okay. So during 2021, we've transferred 100 from this 300 to the P&L. So it's left with what? 200,000. Okay. And the 200,000 will have to be transferred to P&L in the years 2022 and 2023. So here, we are going to recognize the 200, the remaining 200, as a deferred income, as a liability, because we've not earned it. Although we have the grant, but we've not earned it. Okay, because we said we recognize it when you earn it. All right. So this 200,000, you are going to split it, okay, into the current portion and what the non-current liability. So you are going to split it between to the current liability and also non-current liability. So let's look at how this one is done. Okay, so as 100,000 has been released to the statement of profit or loss, the remaining 200,000 Ghana cedis will be held in the deferred income, as I said, to be recognized over the next 2 years, here 2022, 2023, because the first year is 2021. Of this, out of this 200,000, 100,000 will be released within a year. So 100,000 will be released in the what? The next year, that is 2022. So that 100,000 that will be released within 1 year will be held within current liabilities. So 100,000 out of this 200,000 will be held in current liability, and the remaining 100,000 will be held as non-current liability, because this 100,000 will be released to P&L in the year 2023. So you see what I was explaining. The year in question is 2021. Okay, the whole grant is 200,000. In the year 2021, we will release 100,000 to P&L. So it's left with what? 200,000. Okay, it's left with 200,000. Now, out of this 200,000, 100,000 will be released in what? 2022. Then the remaining 100,000 will be released in what? 2023. And this is how you split the deferred income on the liability to the current portion and non-current liability. So the one that will be released within a year is what? 2022, because from 2021 we're going to 2022. That's 1 year. So this 100,000 here will be shown as what? A current liability. The one that will be released beyond 1 year, here the 100,000 that will be released in 2023. So if you are in 2021, 1 year, 2 years, so you have 2 years before you get to 2023. So that one will be held in the non-current liability. So this 100,000 will be non-current liability, and this 100,000 will be current liability. So that is when we are using the deferred approach. But if you are using the other approach, you can just deduct it from the cost or the cost of that particular revenue grant. Okay. So this one is to keep staff employed within a deprived area. So this is a revenue grant. So this one you can use the deduction approach or the deferred one. So this one is saying that this can be shown as a separate line in the statement of profit or loss, or you see, or here, deducted from administrative expenses or whatever the staff costs are charged. So we are saying that you deduct it from the related expenditure. So here the related expenditure is to what? Keep the staff employed within a deprived area. In other words, there may be salaries or any other incentives. So that's what it means. That's the illustration one. Okay. Please, do you need any other clarification in the illustration one? Hello.
Okay, I don't know about the others.
So please, who needs
Okay.
all right. Ojam.
Winnie says she can't log in on. If someone can help her out.
She says her network.
Oh, okay.
Hi, senior.
Yeah, I'm trying to ask if you are
Hello.
okay.
Yeah, I'm okay. Today my background is not good. That's why I'm not participating, but I'm following up. Thank you.
Okay. So I think we can continue. So she's saying her network. Okay. So please read the illustration 2.
Okay, illustration 2. Jinyame. Jinyame, Jinyame Limited received a grant of 50 million cedis to compensate it for costs it incurred in planting trees over a period of 5 years. Jinyame Limited will incur such costs in this manner: year 1, 2 million; year 2, 4 million; year 3, 6 million; year 4, 8 million; and year 5, 10 million, making a total of 30 required. How will the grants be treated in the books of Jinyame Limited according to IAS 20?
Okay, so I forgot to say one thing. So this one, the 100,000 that will be released in 2021 will be sent to P&L, and it will be under the category. You see, after a gross profit, you see other income. Okay, so other income, then you write the 100,000 there. Okay, the 200,000 will be sent to the statement of financial position. Okay, so this one too, we have 5 years, and we've received grant of 15 million. Okay, now we are planting trees. So this one is what? a revenue grant related to expenditure. Now, the cost of this project or cost incurred in planting trees over a period of 5 years is what? 30 million. So in year 1, we incurred 2 million, year 2, 4, 6, 8, and 10 in the years 3, 4, and 5 respectively. Okay, so this is the years that we have and the cost. Now, the grant that we've received, we have to apportion it. Okay, so we have to do it in a such a way that all the years, year 1 to 5, will get a fair share of the grant, 15 million. Okay, so this one is just simple question. Let me put it that way. So this one will be let's say year. Okay, so we have year 1. Let me bring them millions sign here. Okay, the year 1, the calculation will be 2 million for that particular year. The total cost is what? 30 million, so over 30 times the grant of 15 million. Year 2, it will be the cost incurred, 4 million, over the total cost of the project, 30 million, times the grant received. Year 3, it will be the 6 million, over the total cost of the project, 30, times the grant received, 15 million. Year 4, it will be 8 million, over the total cost of the project, times the grant received. Year 5 and the final year will be 10 million out of the total cost times the 15 million. So please give me the grants that will be sent to each year.
The first one is 1.
Yeah,
Yeah, 1 is 1.
1.
Year 3 is 6.
Year 2 is 2.
Year 2 is 2. You said year 3 is what?
Year 3
3.
is 3.
I had 6.
Year 4 is 4.
And year 5 is 5.
Yeah.
So I think it will be 15 million, right?
Yeah.
Yes, because we must get this one. Now let's look at how this one will be shown in the extracts. Okay, so this one we are using the deferred credit method because we transfer it on a yearly basis, or we transfer it towards annually. Now let's see. Let's look at the P&L. So we are going to do the separation here, or we are going to do the splitting here. So please let's pay key attention here. So P&L extract. Okay. So year 1, I don't know if I can do it here. Okay, you let me manage. So we have the other income. We have year 1, 2, 3, 4, 5. Okay. And this is just an extract. So if you are copying, just bring the CD sign down here. I forgot. So in year 1, the other income will be government grants. And year 1, we transferred 1 million. Year 2, we transferred 2 million. Year 3, 3 million. Year 4, 4 million. Year 5, 5 million. So bring this sign. Okay, so this is simple as that. We don't have any depreciation. This is just revenue expenditure. So we are not going to calculate depreciation Let's go to a statement of financial position extracts. Okay, we're going to use the same years. So we are going to split it between current and non-current. So please let's take key attention here. So current liability and also non-current. They are all government grants. Okay, I don't have space. That's why I can't write it here. Okay. Oh, why? Other heading.
They be anything.
Because my head ever quiet idea. Yes, ever confuse you. Okay. So the whole grant is what? 15 million. Yeah. The total grant that was given is what? 15 million. So this one is what the deferred approach. Oh. The whole grant is 15 million. Now, the 15 million, the thing is 15 million. Okay. 15 million. In the first year, already in the first year, we've transferred 1 million out of it. So it's left with how much?
14 million.
14 million. So do you agree with me that this 14 million will be treated as what? Deferred income or a liability?
Yes.
Because 2 plus 3 plus 4 plus 5 should give you 14. So 2 plus 3 is what? 5. Plus 4, 9. Plus 5, 14. Okay. So in the first year, we've already transferred 1 million here to the P&L. So the grant left or the deferred income is now 14 million because we've transferred 1 million to the P&L here. Okay. So it's left with 14 million. This 14 million is what you are going to split to what? Current and non-current liability. And this is where sometimes people get confused. Okay. People get confused here. So let me use this simple approach that will help you to capture this thing fast. Of this 14 million left, that is the 2, 3, 4, and 5 in years 2, 3, 4, and 5 respectively. Now, how much of this 14 million will be transferred in the next year? Here in year 2, how much will be transferred to P&L?
2.
2 million. So that one will be a current liability when you are in year 1. So if you're in year 1, the immediate the immediate subsequent year is what? Year 2. And the grant the amount that will be transferred to P&L in that subsequent year is what? 2 million. So now if you take 2 out of the 14, how much do you have left?
12 million.
So the 12 million will be paid in years 3, 4, and 5. So the 12 million will be paid in year 3, 4, and 5. So this one 7 plus 5, 12. So I gave you an explanation earlier that the portion that will be transferred within a year is current liability. So if in year 1 and this one will be transferred in year 2, you're in 1 year, so current liability. But 3, 4, and 5 will be transferred in year 3. So if you're in year 1, 1, 2, before you get to year 3. So this one is beyond 1 year. That's why we are categorizing it as what? 12 million non-current liability. Now, this 12 million here as a non-current liability will be the balance that you have here, 12 million. Will be the balance that you have as your non-current liability in year 2. In year 2, if you want to know the total liability, you are going to use this particular approach. So non-current liability in year 1 is 12 million, and that 12 million will be your total deferred income or total liability in year 2. That non-current liability left as 12 million. It will be a total deferred income in year 2. Now, let's split this one to to current and non-current liability. We are in year 2. Year in question is year 2. How much will be transferred within a year, or how much will be transferred in the subsequent or the immediate year? We are in year 2. Let me use years, the actual year. So here is 2015. Example, 2016. Here is 2017. Here is 2018. Here is 2019. Now, we are done with 2015, so don't bring the 2015 here. Now we are in 2016 now. The deferred income or the total liability we have left is of 12 million. Out of the 12 million, you have to split it to current and non-current liability. So the current portion is the one, we are in 2016. So the current portion is the one that will be transferred to P&L in year 3. That is 2017. So we are in 2016. If you want to know the deferred income, that's the current liability in 2016. The current one is the one that will be transferred in 2017. So 3 million will be transferred in year 3. So that one will be a current portion when you're in year 2. Subtract 3 from the 12. How much do you have left?
9.
9. Or you've taken the year 3 or 2017, the grant for 2017, you've taken it towards current liability in year 2. So this one is done. This one is also done. So you are left with what? 9. That is 2018 and 2019. So that's why we are having 9 here. So the balance that will be we have is what? 9. Because we are left with what? 2018 and 2019 grants. If you add the two, it's what? Is 9. The 4 plus 5 is 9. Okay. Now the year in question is what? Now we are in year 3. Year 3. If you check the column 1, 2, 3, year 3. Now in year 3, how much will be transferred in year 4? We are in 2017. How much will be transferred in 2018?
4.
4 million. So that one will be your
Current.
current. Okay, that one will be your current. So 4 minus 5, 4 minus 9 will give
Will be 5.
5. In other words, you are in 2017. You know that we will transfer 4 in 1 year's time. Okay, 1 year time. So that one is current. So the one that will be transferred to P&L in 2 years' time is 2019. That's why you have 5 here as the non-current liability. Now the 5 will be the balance you have as total deferred income in year 4. So you have 5 here. Now you are in 2018. That is the year 4. How much will be transferred within 1 year? In other words, how much will be transferred in 2019?
That would be 5.
5. 1 left. So that one will be the current portion. So we are done with it. You don't have any deferred income in 2016 or whatever. So there's no non-current. In year 5, that is 2019. We don't in year 5, 2019, we don't have any deferred income left. Okay, we don't have any deferred income left. So because the 5 that we have, we've presented it as what current liability in year 4. So in year 5, you have nothing, you have nothing here. So here will be dash. So that is how we do the separation. Please, are you okay with this question?
I'm okay with it. I don't know about the rest.
Oh, please, the rest, are you okay?
Yeah.
Jam, are you fine? Oh, Whitney couldn't join again. Okay, so maybe her network. All right. If we are okay, we can move on. Can move on. All right. So let's move on to illustration 3. Illustration 3. The illustration 3 is quite simple question. It's more like the first one. So I want us to skip to illustration 4 because we have to solve this one and also move on with the repayment. We have barely 1 hour left. Okay. So this one to the question illustration 3. Let me just explain it. It's like the company here, the Dynamic Limited, was granted 10,000 acres of land. Okay. And the condition attached to this grant was that Dynamic Limited should clean up this land and lay roofs by employing laborers from the town. The town is a whatever in the eastern region. So the government has a fixed minimum wage payable to the workers. So the workers that they are going to employ from the town, they have what minimum wage payable. The entire operation would take 3 years. So the number of years is what 3, and it's estimated to cost what 100 million. Okay. Now we are saying that this is how they are going to get the grant. Okay. And sorry, this is how they are going to spend this 100 million in the next 3 years. In the first year, they are going to spend 20 million. Second year, they are going to spend 20 million. And the third year, they will spend what? 60 million. The fair value of this land is currently 120 million. Okay, so this one it was just illustration to show you how you are going to do that appropriation that we did, apportionment that we did here. Okay, so we know that fair value, if not treated fair value, but let me just talk something about it. You are going to use this fair value, and okay, so it will be like this. Let me do the year 1. So for year 1, illustration 3. The year 1 will be the 20 million that will be released here, the 20 million in years 1 and 2, over the total cost, 100 million, times the fair value of the land. Because the land is what they've they received as a grant, the 10,000 acres. So times 120 million. So in year 1, they are going to get grants of what 24 million. Year 2 is just 20 million over the 100 times the same fair value of land. That one will also be 24. Okay. Then year 3, it will be 60 million over 100 million times 120, the value of the land. So here, the value of the what grant was 15. That's why I multiply by 15. The cost incurred in year 4 is 8. Total cost was 30. So it's the same thing here. It's the same thing here. The same thing here. The same thing here. So please, let's move on to illustration 4 before okay, let's do illustration 4. Illustration 4 and 5. Then we move on to this one. I'll move with what speed. So please, don't worry. So please read illustration 4 for us.
So illustration 4 required, show how the above transaction should be treated if the company A writes off the grant against the cost of the non-current assets, and B treats the grant as a deferred credit. A company receives a 20% grant towards the cost of a new item of machinery which costs 100,000 cedis. The machinery has an expected life of 4 years and a nil residual value. The expected profit of the company before accounting for depreciation on the new machine or the grant amounts to 50,000 per annum each year in the machinery's life required. Show how the above transaction should be treated. If the company A writes off the grant against the cost,
So
then
that's the
B,
deduction. A is
yes,
deduction
then
approach.
grant treats the grant as a deferred credit.
So we come to the deferred credit. So as I said, this one I'll move with speed. So if you don't get it, just tell me. So this one I explained that you just deduct the grant from the here. I gave you the a summary here. The grant is deducted from the cost of the assets to ascertain the reduced cost. Depreciation is calculated on the reduced cost. In the statement of financial position, the PPE is carried out to reduce costs less any accrued depreciation. So let's use that here. Let's apply that one here. Okay.
Okay.
So just um, let me just hang 3 zeros here. So the cost of the assets, I'm hanging 3 zeros. So let's take note. Will be what 100, right? 100,000 baht. I'm hanging 3 zeros here. Now the grant, you deduct the grant from it. The grant received is what 20% of the assets costs. So 20% times 100 gives us what 20,000, right? That's the 20 here. Are you okay?
Yes, please.
Yes.
Okay. So the reduced cost is 80, right?
Yes.
Okay. Now, you are saying depreciation is calculated on what? If you are using the deduction approach, the depreciation is
Reduce
calculated on
cost.
what?
The
Reduced
reduce.
cost. So your depreciation charge for the year will be the reduced cost here 80,000 over how many years? Expected life of what? 4
Okay.
years. So we have depreciation of what? 20,000 per annum. So per year. Per year. So let's look at the P&L extracts. P&L extracts. Profit and loss extracts. So we have 4 years. Okay. Year 1, 2, 3, and 4. So from the question, we have profit. Profit is what? 50,000. Profit per annum. Where is the profit? Yes, where is it? There's expected profit of the company before accounting for depreciation on the new
50,000.
amount. Yes, 50,000. So 50,000. Yeah, 50,000. Yeah, 50,000. Yeah, per annum. So we are saying 50,000 per annum in each of what the machinery's life. So that's why you're having 50,000 here. All right. Now we have depreciation. So our expense will be depreciation. And now you know that we subtract depreciation from what? The profit. Depreciation we got 20,000 here. So 20,000 per annum. So what will be our profit before tax? Yeah, the revised profit or maybe the PBT. Yes, before
30,000.
tax. So 30,000 throughout.
Yeah.
And in the statement of financial position, the PPE or the asset will be carried at what? When you're using the
Re-
deduction approach
at the reduced cost.
and the reduced cost, less
Depreciation.
any accumulated depreciation. So this one non-current assets, we have machine. In year 1, so we are saying it will be carried at the reduced cost 80, less any accumulated depreciation. So in year 1, the cost will be 80 minus the depreciation of what? 20. Okay, so that one will give us 60. 40,000. So this one, it was the 80K minus the 20K. Please, I hope you understand.
Yes, please.
Okay.
Yes.
So in year 2, okay. So what will be the net book value in year 2? I want you to tell me.
60
To be
minus 40, making
to be
40.
40.
To be 40,000. That one would be, you can do it 80 minus 40 or 60 minus the
Minus
20.
20.
Yes. So here will be 20,000 as the 40 minus 20. In year 4 will be what? Dash. That one is
Dash.
what? 20 minus 20. So as I said, corporate reporting, you are never going to get deduction approach. Because F, who say F4. Okay, so let's go to the B. This is what we will get. Even corporate reporting, you are going to get maybe about repayment. So deferred income or the deferred credits. So deferred credits. Okay. So with the deferred credit, we said the depreciation will be charged on what?
Reduce cost.
Deferred credit.
Sorry, deferred credits. It's on the cost itself.
Cost.
Yes. So here the depreciation will be on the cost. So 100,000 divided by the 4 years, the useful life. We have no residual value, so it is 25,000 per
Yeah.
annum. Okay. So please, I hope you understand.
Yeah.
Yes.
Okay. Now let's look at the grants or the deferred income. You are saying the grant is 20% of the assets, 20% towards the cost of new item of machinery. So 20% of 100,000 is what?
It is the 20,000.
So 20,000 per annum. So you amortize the grant. So let me write amortization of grant. That's where you transfer each year the portion to so amortization of grant. The whole grant is 20,000. Okay, divided by what? 4 years. So please, how much do you have per annum?
5,000.
1,000.
So 5,000 per annum. Okay. So please, let's look at how the P&L will look like. Okay. So, okay. So we have years 1, 2, 3, 4. So we have our profits 50,000 throughout. Okay. Then we have depreciation. Before that, other income will come in here because we are using the deferred method. So here, government grant. So in every year, how much are you going to recognize in the P&L?
Um,
Amortization of grant here,
5,000.
5,000 per annum. The whole grant is 20,000. You transfer it to each year, total of 4 years, so 5,000 per annum. So every year you transfer So in year one, you transfer 5,000. Year two, you transfer 5,000 to the P&L. In year three, you transfer 5,000. In year four, you transfer 5,000. Then done. Before bring your depreciation. Depreciation here was 25,000 per annum. So depreciation. This one is negative. 25,000, 25,000, 25,000, 25,000. So please, what is the PBT? Profit before tax.
30,000.
So please, have you seen this one in effect? Whether you use the reduction or deferred approach, it has no effect on it has no influence or effect on the PBT, right? Because the first one you got 30,000, here too we are getting 30,000. So whether you use deferred or deduction, it has no effect on the PBT. Let's look at how the statement of financial position will be. So you see, with the first approach, that's the deduction approach. Okay, you're not going to see it in what the statement of financial position. That one you only see the asset. But with the deferred one, you are going to see it here. So the statement of financial position extract. So we have years 1, 2, 3, and 4. So let's pay attention here. So with this place, first of all, you recognize the non-current asset as what? Machine. So this one, we are saying it will be carried at what? This one will be carried at what? Hello.
Yeah, hello.
This one will be carried at what?
Are we carrying
75.
why
Said,
75? It's not how
so what's the answer?
it should be carried at
Uh,
100. Okay, 100 minus 25, so 75.
Thank you. So that's why we're having 75,000 here.
Alright, okay.
So it will be the 100 minus 25. So here too,
50.
50,000. That is the 75,000 minus the 25 each year. And year three to be 25,000. So that one will be 50,000 minus 25 depreciation. Year four it will be dash because that one will be 25,000 minus depreciation charge of 25,000. So now here is deferred approach. So we are going to have the non-current liability. Okay. So we are having liability here. Government grants, okay. So let's split it into what? Current and non-current portion. Okay. So please, let's do that. So in year one, who can lead us here? I want to see if you really understand. Let me first set this one in place. Okay, so the whole grant was what? 20,000. Here, 20% of the distance is 20,000. In year one, in the first year, we've already transferred 5,000 to the P&L, right?
Yeah.
So in year one, we've already transferred. So how much left? So it's left with 1, 2, 3,
2,
15,000, right? Yes. Of the 15, how much will be held in the current liability and how much will be held in non-current liability? I want to see something.
5,000 for current liability and 10,000 for non-current liability.
Thank
I
you.
second her.
You said,
I second her.
thank you. So, this one is okay. Now we are left with what? 10,000. This one, 10,000 will come here as your balance. Okay. Uh, In year 2, you have 10,000 left because when you are in year 2, when you are in year 2 here, you have year 3 and 4. So it's 10,000. So out of this 10,000, how much will be held in current liability? How much will be held in current liability?
5.
So 5,000 will be paid in year 3, and the next 5,000 will be paid in the next 2 years. That's year 4. So
Yeah.
5,000 will be here, 5,000 will be here. Okay. Now the balance you will be having in as at year 3 will be 5,000. Now the 5,000, you are in year 3. You have 5,000 left. So it's just year 4. So you are going to release 5,000 in the next year. So that one will be your current liability. You don't have any current non-current. So here will be dash, here will be dash, here will be dash. But the fifth question is the type of question where at the end of the 3 years, we still have deferred grant and all that. So you see all the type of question we are solving under deferred. You see that it has 4 years and we are dealing in all the 4 years. You can have a type of question that the useful life of the asset may be 5 years, 6 years, but the question, the year you'll be required to prepare the financial statement for will be for 3 years. So at the end of the year 3, you still have something here. So please let's do that fast. Let me just show you the calculation, then you go and treat it. So please read the illustration 5 for me. I wanted to do the illustration 5 in full, but I don't know because I want to do the repayment as well. So please illustration 5.
Okay, illustration 5 required. Advise Junior Mail Limited on the treatment of the grant in accordance with IS 20 for the years 2018, 19, and 20. Kindly scroll down for me so that I can. Yeah. Okay, so on 1st January 2018, Junior Mail Limited received a consolidated grant of 120 million. 3/4 of the grant is to be utilized to subsidize the purchase of a college building for students from developing countries. The cost of the building is 300 million and has a useful life of 30 years. Wow. Okay. The balance of the grant is for subsidizing and subsidizing the tuition cost of these students for 5 years. From the date of the grant, Junior May Limited adopted the deferred credit method for recognizing government grants. So we are to advise Junior May Limited on the treatment of the grant in accordance with IS 24, the years 2018, 19, and 20.
So you see this type of question. The asset alone has a useful life of what? 3 years, right?
30 years.
Sorry, 30 years.
Mm,
Okay, we jump center. Okay, 30 years, but we are required to do just 3 years. That's why I'm saying that there are some type of questions that at the end of, let's say, year 3, 2020, you still have deferred income to show. But you see, this one, we didn't have anything. Dash. The previous one too, it was dash. So let's calculate this one. So this one we have. Do you agree with me, man? You have all the 2 types of grants here. We have revenue and what? Capital.
yes.
Okay. Because we are saying that the 3/4 of the grant is to be used to utilize the subs is to be utilized to subsidize the purchase of a college building. So that one is an asset. So grant related to asset is a capital grant. Okay.
Mm,
So 3/4 is what? Capital grants. The remaining will be 1/4. That one is what? Revenue grant. Because we are saying that one be used to subsidize the tuition cost of students. So this one is a revenue expenditure. Okay. So 3 over 4 times 120 million will give you
90 million.
90 million.
Okay.
Then 1 over 4 times 120 million will give you what? The remaining will be 30. Okay, 30. Now, the capital or the assets will last for what? 30 years. The revenue or the subsidizing of or the tuition is what? 5 years or last for 5 years.
Yeah.
So let's look at the depreciation of the asset first. So the depreciation is what? The cost of the assets, okay, will be, and where is it? Where's the cost of the asset? The cost of the building is what?
300.
300.
300.
300 million, sorry.
Divided by the useful life is what? 30 years.
Yes.
So what will be the depreciation charge per annum?
10 million.
10,000 per annum.
1,000, yeah.
Now let's look at the amortization of grants, how the grants will be transferred in years 2019, 2018, 2019, and 2020. So amortization of grants. Okay. So that one will be first of all, the capital. The grant is 90 million or the 90,000. Let's use the thousands here. The 90,000 over the useful life of the asset, 30 years. So this one will be what? Revenue 25 years.
3,000.
So this one is 3,000 cedis per annum. What are the revenue?
Yeah. 6.
Yes, 6,000 per annum. Right?
Yes.
Okay. Let's move on. So please, first of all, let's look at the P&L extracts. Let's look at the P&L extracts. Today, I think we go beyond that. Okay, P&L extracts. So we have just 2019, 2018, 2019, and what? 2020.
2020.
At the lives of the tuition and also the assets goes beyond 3 years. That's what I was trying to say. Okay.
Yeah,
So
that's fine.
we don't have any profit. So other income. The other income, we are going to have capital grants and also revenue grants.
Grants.
So capital grant is 3,000 each year. Okay.
Yeah.
Revenue is what? 6,000 each year. Then we have our depreciation. Depreciation charge of what? We calculated the depreciation. Where is it? Yes, 10,000 per annum. So that one is a negative one. So extracts, this is how you are going to do it. Okay. Let's look at the SOFP extracts. I want to see if you really understand what I'm teaching you today. So 2018, 2019, 2020. So with the non-current assets, building. And for the first year to be carried out what?
First year, it will be carried out 290.
Yeah, so the cost of the asset 300,000 minus the first depreciation in the year 1.
1,000. So 290, yeah.
90,000. So it was 300 minus 10. Okay. What about year 2? So it will be 280.
280.
Every year to be increased by 10,000. 270. Okay. Now let's look at the liability aspect. We are going to split it. we are going to split it. So current portion and non-current liability. Okay. So this one is not just one, so there's no need for us to add it because it will confuse us. Because this one it involves capital and revenue. It's not just revenue or capital. Okay. So let me bring space. For the current, we have the first of all, let me bring the revenue grant. We also have the capital grants.
Right, okay.
Non-current, we have revenue grants. We have what? Capital grants. Okay. So let's focus on the capital grant.
Okay.
The capital grant was what? 90,000 here. 90,000. We are dealing with what? Thousands. They're hanging three. This is just extra. That's why I'm not showing the zeros. So 90 million. Now in year one, how much was transferred to the P&L?
3,000.
3,000. So 90,000 minus 3,000 will give you what?
87,000.
87,000. Now 87,000 is the total liability. We are going to split it. Now out of the 87,000, 3,000 will be released in 2019. So 3,000 will be showed under what? The current portion. So 3,000 minus 87 will give you what? 84,000. Okay. Now in the next year, 2019, we are going to send or release 3,000 to P&L. So you'll be left with what? 81,000.
81.
And 3,000 will be released within a year. That is the 2020 the 2020's grant that will be sent to P&L. So it will be 3,000 here.
78.
Thank you. 78. Once I said that, then 3,000 here. You see, this one there was no dash because the years will move on to 30 years. So you end it here. The grant too is 5 years, but we are limited to 3 years. So that one too, there will be no dash. Okay. The grant too, it was what? The revenue.
1,000.
It
It was 1,000.
That one is the 6,000 per annum.
30,000.
Yes,
6,000.
30,000. 30,000. The grant was 30,000, and per annum was 6,000. So
Yes.
in year one, it is 30,000. In year one, you've already transferred 6,000 to P&L. This one. So minus 6 will be 24. Out of the 24, you release 6,000 in 2019. So that one will come here. Then 18,000 will come here.
Yeah.
Okay. Then when you go to year 2, so 12, good, because 6 will be released in 2020, so that one will come here. Okay, so 6,000 will be released in the next year, that's 2022, but we are not showing that one. Okay, and the amount like what? 6,000, that will be 2022. So that's how you treat it. So please, I hope you are okay with it.
Yes.
Okay, yeah. So if you get this concept, you are good to go. But mostly, this is where the challenge is. They will do everything, but to separate it, current and non-current is the issue. So sometimes when people get here, they add the two. They just write deferred income. Okay, they just write deferred income. But when you are dealing with the standard, sometimes you need a text. So you split it for them to know you know what you are doing. Let's move on with one last subtopic, and we'll be done with this and call it repayment. Repayment of government grants. Now, the grant, as I said, if you get any grants and it does not have conditions attached to it, or you don't have related expenditure, they just give you the grant. Condition bianca home. You don't know what you are going to use it for. There's no related expenditure. Just credit it to P&L immediately. That one will be like grants received. That one just received it. You don't know what you are going to use it for. You don't have any conditions attached to it. That one just recognize it in the P&L immediately. That one you term it as what? P&L other income. Okay, P&L other income. That's all. So what we've been doing, or the question we've been solving, you see that we have conditions attached to them. That's why we recognize. That's why we went through all these workings. Okay. But here's the case. If you fail to meet any of the conditions, you'll be asked to pay back the grant, whether in full or part. So you get some situations where you'll be asked to pay part, sometimes you'll be asked to pay the full grant. Okay, whether you pay the full grant. So this is what I can give you here. And they are not able to meet the conditions attached to it. Okay, attached to the grant. The full amount, the full or part of the full. The full amount of the grant, okay, the grant received or part of it may become payable, okay. Repayable, sorry, repayable. Now let's look at how to deal with this repayment. Now we are saying that any repayment should first be set off against any unamortized deferred credit. In other words, the deferred income, the amount that you are having in the deferred income here. So if maybe this particular example, you go to year 2, we said that, oh, you shouldn't make any redundancies. Now, at the end of year 2, there was a redundancy, okay? You fail the conditions, so you have to repay the amount. You have to check the amount, the deferred income you have total. So here, as at year 2, the total amount is 10,000. That's what you have in your deferred income, both current and non-current, 10,000. So the repayment, first, you have to go to the deferred income, offset it. So what you are going to do is that liability is a credit component, or it's having a credit balance. So what you are going to do is that you are going to debit deferred income. It means you are setting it off. You know, assets are having debit balance. If you dispose of an asset, you credit it so that you cancel that balance. The same way liability is a credit balance. So if you want to offset it or cancel it, you have to bring it to debit side. That's what I'm trying to say. So first, the repayment that you are going to do, you have to go to the statement of financial position. Then you debit the deferred income. That's the double entry. In principle, that's how you work it. So you set it off. So you pay everything here, 10,000. Then if you are paying the full amount, let's say the full amount was 15,000. Okay, you deduct the 10,000 from it. You have 5,000. The 5,000 here will also go to the P&L as repayment as an expenditure. So let's see. You solve a question, so don't worry. Any repayment should first be set off against any unamortized. So any unamortized deferred grant simply means the grant that has not been released to the P&L. That's what it means. It's meant by the unamortized deferred grant. Okay, deferred grant. So this one too is similar to the revaluation. So you check the date of repayment, the date or the year that you failed to meet that particular condition attached to the grant. Then after repayment, you have to calculate depreciation that has not been calculated due to the grant. So if you are in year 2, okay, maybe year 1 you fulfill the grant, year 2 you fulfilled the grant, in the middle of year 3 you failed that condition. So you've consumed first year, second year plus half of year 3. That makes us 2.5 or 2.5 years. What this means is that you have to charge, after repayment, you have to charge depreciation right from year 1. So you are going to charge accumulated depreciation for 2.5 years. Okay. We are going to use illustration so you don't worry. So any accumulated depreciation that was not charged because of the grant must be what? Charged immediately. So if you've spent 2.5 years within the grant and you fill the conditions, you have to charge depreciation right from the first year of the assets. Okay, of the asset. We call it extra depreciation. Okay, extra depreciation. So these are some of the methods: income based, capital based, grants, and all that. But that's not a big deal. I've summarized it. When you get a note, you have to go through it. Okay. So please let's tackle illustration 6. Illustration 6. Then I think that will be our last question. Then you solve this repayment question. Where is it? This repayment. This one, Dodua. It's a repayment question. You solve it and you close. Sorry, we are going beyond 9:30 because things started early and the board was messing up. So please, illustration 6.
Okay. Extras from required. In accordance with IS 20, prepare the financial statement extracts for the year ended 20th June 2017. Extracts from the trial balance of Junior Limited as at 30th June 2017 are: we have property, plant and equipment, depreciation expense, profit on disposal of plant, deferred government grant. See note 2. So additional information: 1. Junior Limited received a government grant of 25,000 on 1st July 2014 in relation to an item of plant with a useful life of 5 years. A condition of the plant was that the plant must be held for 5 years. During the year end 30th June 2017, Junior Limited disposed of the plant and as a result must now repay the full amount of the grant. The disposal of the plant was already reflected in the trial balance. 2. The deferred grant balance as shown in the trial balance represents the balance as at 1st July 2017. Required. In accordance with IS 20, prepare the financial statement extracts for the year ended 20th June 2017.
Okay. So the grant received. Let's look at some. The grant received is what? 25,000. And it was received on what? 1st July 2014.
14.
And the useful life of the asset is what?
5
How many
years.
years?
5 years.
Okay. And we are saying that the condition attached to it is that
It
you
should be
having
held
assets
on.
for 5 years. So the whole of 5 years, you should have you should have control of the assets. But here is the case. At the end, during the year end, June 30, 2017, they disposed of the assets. So from 1st July 2014 to 30th June 2017, how many years?
3 years.
3 years, yes. 3 years. So disposed of 3 years time. Okay. So the useful life of the asset is 5 years. You spent 3 years and you dispose this off. So how many years left?
2 years.
So 2 years left. Good. Let's look at this. I said that any repayment should first be set off against any unamortized deferred payment. So this one was what was the punishment, or yes, let me put it that way. And as a result, must now repay the full amount of the grant. So you've committed, so you should pay the full amount of the grant. Now, we are saying as at the third year, as at this 30th June 2017, the balance left per their trial balance is what? This one they've already calculated for us, so don't worry. It's what? 15,000.
So,
Okay, 15,000. 15,000. So that is your deferred income. In other words, this is your deferred income, or the one you are having in the liability, the statement of financial position. This is what you have. So the rule is saying that any repayment should first be set off against any unamortized deferred grant. And I told you that deferred income is having a credit balance. So if you want to reduce it or set something off against this particular deferred income, debit the deferred income. So you debit deferred income with what? The whole of 15,000. The repayment be done by what? Maybe cash or bank. That one is 25,000. They are saying you should pay the full amount, and the grant received was what? 25,000. So you are paying everything. So you are paying 25,000. Now, 15,000 was what? The deferred income. So you offset it. So you've eliminated it from what? Your books. In other words, you recognized it because you are not entitled to that grant anymore. So you have to de-recognize it from the statement of financial position. That's what we've done here. Because the deferred income is having a credit balance. It was 15,000 here. So if you want to, so deferred income, it is having a credit balance. It's a liability credit balance. If you want to cancel this account off, you debit it. Okay, so at the end of the day, everything cancel each other. So you have nothing left in deferred income. You are asked to pay full amount. Okay, you are paying full amount of 25,000, but in your books you have only 15,000 left. That means that the remaining 10,000 should go to P&L, debit P&L. If you are debiting P&L, it means you are treating us as what? Expenditure. So here, repayment.
hello, Pa. Hello.
Yeah, hello.
Hey, that has gone off. Wow.
Okay, so as I said, as at that date, you were having 15,000 as unamortized grant, deferred grant. So what you have to do is that you set off against the repayment. So you are paying 25,000, it's left with 15,000. So just go and clear the 15,000 first. Whatever is left must be what? Debited to P and L. Must debited to P and L. When you read it here, you see any excess repayment must be charged to the profit immediately. So any excess. So the excess was 10,000. We are charging. If you are charging to P and L, it means that you are what? Debiting P and L. So we debit depreciation and all that. So the P and L and extracts will be the profit on disposal. Okay. The trial balance sheet, profit on disposal. After they dispose of the asset, they got 12,000. So this one is positive figure. Depreciation, they've already calculated depreciation. Depreciation expense is what? 23,500. Okay. Now the repayment will come in, the excess repayment. Depreciation is negative, excess repayment will be negative 10,000. What item again? Then we go to a statement of profit or loss. Statement of financial position. Now, the non-current assets, PPE, what we have left is what? 125,680. 125,680. And this is at the end of this. So I guess they've already considered depreciation. They've already deducted depreciation. Okay. Please, are you okay with the repayment illustration 6? Are you okay?
Yes.
Yes.
Yes, yeah, I will for more.
Oh, we are okay.
Are you tired? I wanted us to solve the last past question so that you know that we are done with government grants. The next time we move on with other standard.
Mm, okay.
So after
Okay.
this, we are moving on to borrowing costs. Okay.
All right.
We move on to borrowing costs. There may be from the increment and that. Okay. All right. So please let's solve this one. Let's solve this one. It's a past question.
Okay.
That's why I said repayments are for what? Corporate reporting mostly. Okay. It was November 2017. So November 2017. See our question 2A. So please let's read. Let's read. Do one. Let's solve this one and close. Okay. So we have
Dodowa Limited is a large textile manufacturing company. Wherever possible, it structures its operation to take advantage of any financial assistance available from national and regional authorities. During the year, a heavy-duty equipment was purchased for Dodowa Limited's main manufacturing operation for 12 million cedis on 1st April 2015. The equipment was expected to be used for 10 years, with a zero residual value. Dodowa Limited pre-applied for a government grant on 1st January 2015, meeting all necessary criteria for awarding of the grant. On 1st February 2015, the grant was awarded for 40% of the equipment cost, and the cash was received on 1st July 2015. Conditions relating to maintaining employment are attached to the grant, and if they are not satisfied, then the grant becomes repayable or partly repayable. Dodua Limited expected to meet Dodua Limited expected to meet these conditions when the grant was applied for. However, due to worsening economic conditions, redundancies of some staff on 31st December 2016 resulted in a repayment of 10% of the original grant becoming due. The repayment was made on 1st February 2017. Dodua Limited accounted for the grant as a reduction in the carrying amount of the asset required. Explain with suitable calculations the financial reporting treatment of the above in the financial statement of Dodua Limited for the year ended 31st December 2016 in accordance with IS 20, that's accounting for government grants and disclosures of government assistance.
Thank you. So let's look at the dates. Let's look at the dates. On what they are just trying to confuse you. Okay. So on 1st January 2015, what happened? On 1st January, they
2015
pre-applied. Okay.
for the grant.
Have you seen it? Pre-applied.
Yes.
Okay. Now, 1st February 2015, they met all conditions. Okay.
They were awarded the grant.
Yes, 40% of the equipment. So we come there, we come to this place. So they are awarded that place, and the cash was received on 1st July. And 1st July 2015, right?
Yes.
Grant received. And they made redundancies on as at what? 31st December
2016.
16.
So this date is when we are going to do the repayment. So forget the repayment was done on 1st. This one, forget it. Okay, forget it. Because the main working will be based up to this place. Now, let's think about this one. The building or the asset, okay, what is the asset? The equipment was purchased on what date?
1st
1st April
2015.
So the costs of the equipment 1st April 2015 is, let me
12.
hang 3 zeros.
Okay, 12,000.
So 12,000. Grant, they said 40% of it.
$4,800.
4,800.
800.
Okay. 4,800. Now the reduced cost is what? So mostly the repayment will
7,000.
you'll be using sometimes using the deduction approach and all that. Okay.
7,200.
7,200. All right. Now the depreciation. How are you going to calculate the depreciation? It will be 7,200 divided by what's the useful life of the asset? 10 years, right?
Yes.
Mm.
Are you going to charge a full year depreciation?
No.
No, for the first
How many
year.
months?
By so 9 months.
9 months. So 9/12.
Nine
Because
months.
they
No.
acquired it on 1st April
First,
2015.
yeah.
The 31st month is 9 months. So what
Mm.
are we having as depreciation here?
540.
540.
Yeah.
Now we are having the current amount as at 31st December 2015 as what? You see why I was saying that PP is the mother of all asset standards.
Mm. The current amount.
6,660.
6,660. Okay. Now I've been telling you it's more like revaluation. Look at the date that they failed the condition. The date that they failed the condition. I've summarized the date here.
Mm.
31st December 2016.
No.
Is that
Yeah, 31st December 2016.
this one is carrying amount as at 31st December 2015. How many years left?
1 year.
So you have to charge depreciation for another 1 year to get the carrying amount as at the 1 year. Okay.
Okay.
Hmm.
So that one there is 4 years. So 7,000 still on reduced cost, but 10 years. So this one will give you 720. This one is 1st January to 31st December, so 1 year. So the
Mm.
current amount we'll be having here will be as at 31st December 2016. So please, what's the current amount?
5940.
5940.
40.
Okay, 5940. So we filled the conditions there. So we have to revise the carrying amount. Okay, because this is not the carrying amount that we will be having as at the end of that year. Because they filled the condition and they should make what repayment. So this date is where they are going to make that repayment. So repayment of grants. So the grant repayment will be what? They are saying they should pay 10% of the grant. Now the grant was
Original
4,000
10,000.
down
800.
times 10%,
480.
480. And I told you, so now from the date that we acquired the asset or the date that grant was received up to the date they filled their conditions, how many years?
One
3 years and some months.
one
A
and
He
a
year.
said 2 years.
one and
One
a
and a
half.
half.
He said,
One and a
One and a
half.
half.
hey, we are sure. Now,
Uh,
in the first year, okay, in 2015,
Was 7 months, 9 months.
the depreciation was what? 9 months. In 2016, it's what?
2 years. So 1 year, 9 months.
Yeah. We are getting 1.9 years.
please. I'm a bit confused here. You
Don't be confused. Uh-huh.
from when the grant was received.
Uh-huh.
Are we going to ignore the date the grant was received? Because per your analysis you have made, the grant was received in July.
Mm-hmm.
Yes. So if it's in July, then that will make it 6 months.
Okay, maybe right now what I said is confusing you, right?
Yes,
Check
please.
this. Any accumulated depreciation that was not charged because of the grant must be charged immediately. So you start from where the the asset was ready for use, where we started charging depreciation. So when did we start to charge depreciation for that particular asset?
Okay. All right. I
So
get
from the first April,
it. Okay.
right from the day that they acquired the asset. So
Okay.
whenever you are dealing with repayment, the additional depreciation you are going to calculate, you should look at the date that they started charging depreciation. That's the date the asset was ready for use. It was in teachable state and maybe the location. Not the date the grant was received. Okay, the repayment one. So we are saying that any accumulated depreciation that was not charged due to the grant must be what charged immediately. So that's what we are trying to do. Okay.
All right. Okay.
So
Thank you.
we name it. Thank you. You're welcome. So additional depreciation. So the additional depreciation, this is how you're going to calculate it. It is the repayment amount. Okay, the 480 over the useful life of the asset. It was 10 years. Yeah, 10 years. And then
Yeah. So
calculated depreciation is what?
one
1
point.
year, 9
Yeah.
months. Okay.
Mm,
So that one will be written as what? 1 whole year, 9 over 12. Because the months is what? 12 months. So what is the additional depreciation?
$84.
84.
Nanikia, please confirm me.
Okay.
So this 84 will be charged to P&L, okay, immediately. Because already you've dealt with the previous one. So please, what is our revised carrying amount? So this is the still carrying amount as at the revised one, okay, 31st December 2016. So how much do you have there?
396.
Oh, from here, we start from this place because you are making adjustments from here.
Okay. Mm,
6336.
6336. This one, they didn't give us any high balance or something. We would have prepared the extracts. Okay, we would have prepared the extracts. So some double entries that we have is what? The assets. It was the repayment is what? 480. So you debit your assets, okay, debit it minus 84. You are getting 396. Okay.
yeah.
Then the depreciation to P&L, it was 84. Yeah, the repayment. Then you credit what? The grant repayable. How much was it?
That's the 480.
480,000. Thank you. This is what we have. They didn't give us the deferred income, the balance.
The grants repayable.
You said,
Okay.
you said,
I'm asking the grants repayable. So
I'm
you
going to
pay
do
out
it.
of cash. So I'm asking if it's like grants repayable into bracket cash or
Yeah, maybe cash or bank. That's the amount you are supposed to pay.
okay.
That's the repayable amount, the repayable amount. And
So
I
it
was
was
saying that
me.
this question, we don't have the full information. We would have move on to calculate what the extracts, okay, where we debit the deferred income, then the balance Okay,
Okay.
where we
As we
deduct
did
debit
before.
and deferred income, we credit the mode of payment, whether cash or bank. Then the repayment, the difference will be the repayment in the P&L. So the information we have here is limited. We don't have um, much information to determine that particular thing. So you see, when the answer they ended at that place. Okay.
Mm.
You know this thing, you do it as say solid man. So but if you don't know the principle, you can spend 20 minutes on this particular thing. Okay.
Yes.
Yeah. So please, if you learn the standards, don't say you have time, you have time. Every day, go over it. As I said, if I were to be you, you join the phone class, don't go and watch the video again. That's a wastage. Okay. So when you join, you write, I'll share the working board, I'll share the notes. During revision, you revise before we move on to the next standard. And that'll help you because if you wait till the examination time before you revise, standards they are 22.
Hmm.
If not done four, select it 18. So imagine the common ones are 22. I think I'll not teach the agriculture IS 40. There may be hyperinflation 29. These ones are not just common. I think agriculture was examined last night, and hyperinflation 20 was March 2025. Yes. But the common ones are 2022. Yes. Assets are having 9, liabilities are having 5, and I think performance, the IS 8, EPS, the IS 10, and all that, they are having 8, making 22. So we've done 4, left it 18. So please, the repayment is not difficult. Just go through. And if you get a question on IAS 20 corporate reporting, it will be repayment. Trust me. The deduction deferred credit approach, that one is for financial reporting. Okay. So please, do you have any question? Any
Yeah.
question for me?
Yeah, I'm okay.
Okay. So without any question, thank you for today. You meet again Thursday.